All right, let's get right into it and look at Bloom Energy, ticker BE. The market is currently closed, finishing the October 28th session. The stock officially closed the regular day at $113.28. That was a very strong performance in itself, up $4.75 or 4.38% on the day. But that isn't the story. That's not what anyone is talking about. The real story, the one causing alerts to go off on every Fidelity trading platform and Robinhood app across the country, is what is happening after hours. As of the latest data, Bloom Energy is trading at $136.01 in the post-market. That is a staggering, face-melting jump of $22.73 or 20.07%. This is the kind of move that liquidates short positions and forces a complete reevaluation of a company. And it's happening right now. The general expectation heading into this print was that Bloom, like so many companies in the hydrogen and fuel cell space, was navigating a very difficult macroeconomic environment. The consensus narrative was all about high interest rates, constrained capital spending, cash burn, and the very long, uncertain road to sustained profitability. The reality, as shown by this 20% explosion, is that the company just dropped quarterly results that seem to have completely wrong-footed that consensus. This wasn't just a small beat, this is the kind of report that signals the underlying business is accelerating far faster than anyone was modeling in their Schwab Intelligent portfolios or SoFi Invest accounts. The market was expecting a B- report, and Bloom just handed in an A+ with extra credit. For years, the common ground on Bloom Energy has been great technology, questionable business model. You'd see it spike on policy news from Washington, then bleed out for months. It has been a notoriously frustrating hold for long-term believers and a very dangerous day trading vehicle for anyone just self-investing. People see the hydrogen theme, compare it to other speculative plays, and maybe allocate a very small, high-risk position using their Robinhood investments account, filed right next to their crypto holdings. But what if that's been the wrong framework all along? What this after-hours reaction suggests, what the market is screaming, is that we may have finally moved past the hope stage and squarely into the execution stage. The market is scrambling in real time to accept that Bloom might not just be a climate change poster child, but a high-growth industrial company that is hitting its stride, right when everyone was looking the other way. Let's break down what a 20% leap actually implies, because a move this violent, this sudden, isn't just retail enthusiasm. This is institutional money waking up and hitting the buy button with force. This is algorithms at Interactive Brokers running new valuation models right now and finding the old price no longer makes sense. The catalyst is without a doubt the company's latest earnings report and the subsequent guidance. The headline numbers must have absolutely crushed expectations. We are likely looking at a significant top-line revenue beat. Analysts were probably modeling one number, and Bloom delivered something substantially higher. But revenue is only part of the equation, especially for a company like Bloom. The real demon, the one that has haunted this stock for its entire public life, has always been margin and profitability. This is where the true analysis happens, far away from the simple buy button on a SoFi trading platform. For Bloom, the bear case was always that they could sell their fuel cell boxes, but they couldn't do it profitably, or that the cost to install and maintain them would eat all the profit. This 20% move suggests that the company just showed a massive improvement in gross margins. Perhaps their new manufacturing efficiencies are finally paying off. Perhaps the average selling price of their units is climbing. Or, and this is the holy grail for a company like this, they may have crossed the line into positive operating cash flow, or even, dare I say, positive GAAP earnings. If they posted a surprise profit, that explains this entire move. It changes the company from a cash-burning R&D project to a self-funding growth business. That's a different asset class entirely, and it warrants a completely different multiple. People using Fidelity Wealth Management Services will be hearing from their advisors about this tomorrow. We also have to talk about guidance. A 20% move isn't just about the past 3 months, it's about the next 12. Bloom's management on their earnings call must have projected a future that makes their previous forecasts look conservative, perhaps even outdated. Are they seeing a surge in demand for data centers? That has been the key narrative everyone was hoping for. Data centers, especially those being built out for AI, need massive, reliable, predictable, and preferably clean power. This is Bloom's entire sales pitch in a nutshell. If they announced a new major data center partner or a significant expansion from an existing one, that right there explains the $22 jump. That is a tangible, multi-year revenue stream you can plug into a model. That's not hope, that's backlog. The trading volume during the regular session was already elevated, suggesting anticipation. Now, in the after hours, the volume is astronomical for this time of night. This isn't just a few people making an online investment, this is a fundamental repricing of the asset by major funds. This is a signal that the Fidelity mutual funds or Fidelity ETFs that have an allocation to clean tech might be forced to increase their weighting. Think about the pressure this puts on competitors. This report doesn't just lift Bloom Energy, it puts immense pressure on Plug Power, on Fuel Cell Energy, on all the other names in the space, to prove they can execute as well. The sector momentum was already shaky. We've seen how a big tech name like Nvidia stock can pull the whole semiconductor sector, but in the clean tech space, it has felt like every company for itself. Bloom just declared itself very loudly as a potential leader of the pack. What makes this move so impressive is the macroeconomic backdrop. This is happening while interest rates are still high. High-growth, capital-intensive companies should be struggling here. The cost of capital is high, making new projects more expensive. Yet Bloom is signaling this kind of strength. It suggests their customers, primarily large industrial and commercial clients, are willing to pay up for their product regardless of the financing environment, because the value proposition, reliable clean energy, is that compelling. It also suggests Bloom's own financing is secure. This is the kind of expectation versus reality gap that defines a new market leader and separates it from the laggards. This is the kind of event that makes investing sites light up and re-rank their top picks. For those who are new to the story and are just seeing this ticker flash across their screen, what is Bloom Energy? It's not a solar panel company, and it's not a wind turbine company. They make what they call Bloom Energy servers, which are often referred to as Bloom boxes. These are solid oxide fuel cells. Think of them as big, quiet, highly efficient boxes that take a fuel source like natural gas, biogas, or increasingly hydrogen and chemically convert it into electricity without combustion. It's clean, it's efficient, and most importantly, it's reliable. It provides 24/7 power, which is why data centers, hospitals, and large manufacturing plants are their key customers. The business model has two parts: selling the hardware, the servers, and then, crucially, the long-term maintenance and service contracts that provide recurring revenue. Historically, the stock chart has been a nightmare. It's been a roller coaster of massive spikes and devastating crashes. It's been a classic high beta name you trade, not one you put in your Fidelity IRAs and forget about for 10 years. It has burned so many people who bought at the top of the last clean energy cycle. But this earnings report, this 20% reaction, might be the inflection point those long-suffering bulls have been waiting for. It suggests the business fundamentals are finally catching up to, and perhaps surpassing, the story. This brings up the big question, and I want you to comment below. Based on this 20% after-hour surge, are you buying Bloom Energy tomorrow morning at the open? Or are you taking profits if you already own it? Let me know what your strategy is. So, where do we go from here? The expectation was a slow grind. The new reality is a potential vertical repricing. The immediate catalyst is this report. The medium catalyst is the data center build-out for AI. The long-term catalyst is the broader hydrogen economy, where Bloom's technology could be a key player. This is a powerful combination. But risks remain. This is not a risk-free investment. Competition is fierce, not just from other fuel cell companies, but from batteries, improved grid infrastructure, and solar plus storage. And execution is everything. Bloom must continue to scale, drive down costs, and manage its growth without tripping over its own feet. We've seen growth stories stumble before. Look at the volatility in Tesla stock, or the ups and downs of Apple stock in its growth phases.